Okay, so this video is going to deal directly with car fringe benefits. So that's covered under Division 2 of the legislation. So the general rule for car fringe benefits are that if the car is used or it's available for private use, then it'll be subject to FBT. Now, obviously, using the car privately is just when you take the car on a private matter. It's pretty simple. However, the concept of being available for private use is a little bit trickier. So what it means is that if you are there and you have the ability to actually use the car for a private matter, even if you don't actually use it, if you just have the ability to use it, then that's considered a fringe benefit. So for example, if it's sitting in your garage, you can easily get up and take it to the shops. That's being available. So some other criteria just to consider. If the car is kept at or near a private residence, then it's going to be a fringe benefit. However, this excludes marked emergency vehicles. So for example, if you had a police car with all the external markings and the lights and sirens, then that would be exempt from FBT. Another, the employer has control of the car when they're not working, and also if the car is off the business premises and it's available for private use, then it's going to be subject to FBT. So the overriding principle really is just if the car is actually being used or it's available for private use, then it's going to be a fringe benefit. Then you can just use these other considerations if it's a confusing question. So the exemptions, infrequent one-off car hire. So say if your employer just hired a car for you, just once, just get from point A to point B, then it's going to be exempt from FBT just because it's infrequent and it's not really regular. Taxis, panel vans, utility trucks, or other vehicles designed for a purpose other than carrying passengers, less than 1 tonne in weight, less than 9 passengers, are going to be exempt if they are used for work-related travel or only for minor, irregular, and infrequent private use. This is because these classes of vehicles are predominantly used in the actual business operation, and so they're more for business purposes rather than providing private benefits. Also, if the car is unregistered and it's principally used for business operations, is exempt. So a car needs to be registered to be driven on a public road. So if it's not been registered for the purpose, then it's exempt if it's used for business operations predominantly. So we have an example here. So the question, on 3 April 2013, Ben Limited purchased a car for $40,000 and paid an extra $4,000 for non-business accessories. The car was provided to an employee from the date of purchase. They travelled 6,000 kilometres for private use and 20,000 kilometres for business purposes, up until 30 March 2014. Ben Limited is entitled to claim an input tax credit for GST purposes. During the year, the following expenses were incurred. Stamp duty on purchase $400, registration $1,000, insurance $1,000, petrol $1,500, maintenance $2,000. So the employee paid for petrol and the employer covered the rest. Calculate FBT payable for the 2014 fringe benefits tax year. Calculate both statutory and the cost method for taxable value and determine which one is best. Okay, so there are 2 methods for taxable value. You can use statutory formula or the cost method. So if the employer does not make an election for either of these 2 methods, it automatically defaults to statutory formula. However, the employer can choose which one they want, and they'd normally choose the one which provides the lowest taxable value, because this means they'll be subject to less FBT at the end. Okay, so statutory formula is ABC on D minus E. So A is equal to the base value of the car. So this includes the actual cost of the vehicle, any non-business accessories that have been fitted to the vehicle, GST, luxury car tax, or any dealer delivery charges. However, it does not include either registration, or stamp duty. Now, additionally, the base value of the car will always be its original cost, except for when it gets to the 4th anniversary of which it has been held. So on the 4th anniversary, then the base value of the car is reduced by 1/3. So when you're doing it for the 4th anniversary there, you go 44,000 multiplied 2/3. That would give you the base value of the car. Okay, so B is statutory fraction. Deal with that in a second. C equals number of days the car is provided. So in this example, we've got the car being provided on the 3rd of April, which means the 1st and 2nd of April, the employer didn't have the car. So we'll need to take 2 days off the number of days in the year to get that figure. So that'll be 363 days. Number of days in the year, 365 days, or 366 if it's a leap year. So leap years are 2008, 2012, 2016. And E is the recipient contribution. So that can come in the form of operating expenses that the employee pays. So in our question, we've got the employee paying the petrol expense, or it can come in the form of a payment the employee makes to actually have the right to have the benefit, or pays for the benefit. So if they paid for some of the actual cost of the car, that would come off. Okay, so statutory fraction. So basically, statutory fraction is just dependent upon the annualized kilometers of the car and the date at which the car was provided. So we know the car was provided on the 3rd of April 2013, so we'll immediately be looking at this column here. And we also need to work out the annualized kilometers. So we know that, we've got this annualized kilometers formula here, which is AB on C. So kilometers traveled, the number of days in the tax year is B, and C is the number of days held in the tax year. What this formula does is it's just saying that, right, if I held the car for the entire year, how many cars would I have traveled? So we know that in our question, the car traveled 26,000 kilometers. There's the 20,000 for business and 6,000 for private use. We know there are 365 days in this year. We know that it was held for 363 days because the car was provided on the 3rd of April. So there are 2 days there on the 1st and the 2nd that we didn't have it. So if we're just dealing with whole kilometers, this rounds to 26,143 kilometers on an annualized basis. So we know that fits into this range here. We know we're looking at this column because of the date. So we have our statutory fraction of 20% or 0.2. Okay, so if we go back here, we know that our base value obviously is $44,000. We multiply it by the statutory fraction, being 0.2 or 20%, which we just calculated. Number of days the car is provided. Again, we know that is 363 days because of what we spoke about before. The number of days in the year is 365. And again, we need to take off the amount that the employee contributed. And so the employee paid for the $1,500 worth of petrol, so we're taking that off the total. So the statutory formula gives a total taxable value of $7,252. Okay, so now we're going to work out the taxable value using the cost method. So the formula for cost method is C multiplied by 100% minus BP and then minus R. So C is equal to the operating costs. BP is the business percentage and R is recipient contribution. So R already worked out 1,500 in the last method, and so that's exactly the same in this one. So operating costs generally include any registration, insurance, petrol, and maintenance. We've included all those in the question. And so the total of those four is $5,500. So they were pulled straight from the question. And so stamp duty isn't an operating cost because it's simply just a one-off tax on the actual purchase of the car, so we don't include that. Now, the other thing is that the ATO specifies when using the cost method that there is a amount of depreciation and interest that you need to include in operating costs. So you include interest whether or not you actually borrowed money to buy the car. So you include depreciation and interest in operating costs no matter what. Okay, so we're going to work out the depreciation here. So to work out the deemed depreciation by the tax office, we have this formula here, which is ABC on D. So A is equal to the depreciation rate. So the depreciation rate is 25% diminishing value method. Now, the way we work that out is by looking at when the car was purchased, what FBT year. It's more than likely it's always going to be 25% because if you buy the car on or after 10 May 2006, and you're considering FBT year 2009 or after, it's 25%. So we fit into the 25% for this example. So the car value, we've worked that out previously for statutory formula. We know that's $44,000. And the number of days the car was held in the tax year, again, we know it's 363 days because we received the car on 3 April. And the number of days in the tax year is 365 days. So this calculation comes to $10,940. The one thing I'm going to mention about the car value here is that for the depreciation only, what we do in subsequent years is we'd take the original cost, which is the $44,000, and we'd take away any amount we'd depreciated. And so that would give us our car value for this formula only. We'd only do that when we're working out deemed depreciation. The base value of the car that we worked out in statutory method will always be the cost, unless it's taken to 2/3 after the 4 years, as I explained. Okay, so because this is the initial year, we're taking it at cost for the depreciation. But say for next year, what we'd do is we'd go 44,000 minus $10,940, and that would give us our figure for the car value only for working out depreciation. Okay, next, so deemed interest. As I said before, we have to include this deemed interest whether or not we actually borrowed any money to pay for the car. So the formula for this is ABC on D again. So we've got A being the interest rate, B car value, C number of days car held in the tax year, and D number of days in the tax year. So the interest rate simply just comes from this table provided by the ATO. So we are dealing with the fringe benefit tax year ending on 31st of March 2014. And so our rate is 6.45%. 0.0645 multiplied by the car value being 44,000. Number of days it was held in the tax year, again 363. And the number of days in the year was 365. And this comes out to be $3,238. Okay. So, again, when you're calculating the deemed interest, as I explained there with the depreciation, you would use the depreciated amount for this car value. Okay, so taxable value cost method, we are ready to calculate it. So our entire operating costs are the registration, insurance, petrol, maintenance that we just pulled directly from the question. And then we've got the depreciation and interest, which we calculated for a total of $19,678. Okay, so let's go. So we know that our cost is the operating cost, so that's 19,678. We need to multiply it by 100% minus the business percentage. So to work out the business percentage, what we want to do is we take the total amount of kilometers which was traveled for business purposes and divide it by the total amount of kilometers traveled. What this does is it allows us to actually work out how much of the car use was for a private benefit. And then we take away the recipient contribution, which we know is the $1,500 of petrol costs. So what we've got here, I've got 19,678 of operating costs, which we calculated before. So this figure in here goes, right, 100% of the car minus how much of the car travel was for business purposes. That gives us the amount which was used for private purposes. So we can apportion the operating cost to the private purposes. And we take away the 1,500 because we know that the recipient contributed that amount for the petrol. So the total of that calculation comes to $13,637. Okay, so we've calculated the taxable value under both the statutory formula and the cost method, but we know that the statutory formula actually provided a lower taxable value. So that's the one that we're going to use to go on and calculate the fringe benefit tax, which is actually payable, because it means we'll actually pay less tax for this year. Okay, so next step is to actually gross up the taxable value. So the way we do this is we take the taxable value that we've calculated from the statutory formula, which came out to be $7,752, and we multiply it by the gross up rate. Now, you just get the gross up rate from the table provided by the ATO. So we are choosing a type 1 gross up rate because the question specified that the employer was entitled to an input tax credit. So when they're entitled to claim the input tax credit, we use the type 1 gross up rate, which is the higher rate. And if they're not entitled to claim an input tax credit, we'd use the type 2 gross up rate. So we know that we're calculating it for the FBT year ended 2014. So we'll take the gross up rate of 2.0647. Now this calculation comes to $16,006. So that's our grossed up taxable value. So we will use this to actually work out how much FBT is payable. So FBT payable is simply the grossed up taxable value, which we just calculated. So that was $16,006 and multiplied by the FBT rate for the year. So again, we're calculating for the year ended 31 March 2014. So the FBT rate is 46.5%, or obviously 0.465%. Sorry, 0.465 in decimal form. So this comes out as a total of $7,442.79, or obviously 7,243 if you want to round it up to being the total. Sorry, whole dollar. So we finished the process. We've got there. We've worked out what the FBT payable is. I hope the video was useful, and good luck with any questions.